In just the last 4 years, the price of eggs went from being $1.50 in June of 2020 to over $3.65 today, a 140% rise. Oil went from around $37 to over $75, a 100% increase. And home prices have gone from $320,000 to $420,000, so a 30% increase. This led to one of the largest inflation spikes in the United States since the 1970s that ended in massive wealth destruction. Since then, inflation has come down quite a bit, and it currently sits at 2.9%. But many are getting concerned by the fact that it seems to be staying stuck at these levels, and in the last few months, even beginning to show signs of turning back up. One indicator that suggests that inflation may actually be heading higher is this line, called the ISM Services Prices Paid Index. This reflects how much businesses are seeing their costs fluctuate, a factor that can directly influence inflation. When this line is high, it means the cost of doing business is rising rapidly. And when this line is low, it indicates business costs are declining. This index has proven to be a reliable leading indicator for overall inflation. If we add the US inflation rate on top and shift it behind by about 3 months, you can see that inflation is closely correlated to the ISM Services Prices Paid Index. And this makes sense because when businesses face higher costs, they often raise prices to maintain their profit margins, which ultimately contributes to higher inflation levels. For example, the ISM Services Prices Paid Index rose about 3 months before the inflation spike in 2021, and it also accurately anticipated the decline in inflation in 2022. Now, in 2025, this index is once again climbing, suggesting that inflation could turn back up in the next 3 months or so. But if we dig a little deeper, we see that one of the most significant drivers of ISM Services Prices Paid in the US economy is wages. Since the 2020 pandemic, wage growth has seen a significant rise, reaching the highest levels in 25 years at one point. Even now, wage growth remains pretty elevated compared to the past decade, which has been contributing to the sticky inflationary pressures we're experiencing. However, the broader trend shows that wage growth has been consistently declining since its peak in August of 2022, and there are signs that this trend is likely to continue. That can be seen by putting the chart of job openings on top of wage growth and shifting the chart of job openings forward by about 1 year. You can see that throughout history, job openings have been quite a strong predictor of future wage growth. The reason this relationship exists is when there are plenty of job openings in the economy, workers feel confident about finding a new job and are more likely to negotiate for higher wages. But when job openings decrease, workers tend to prioritize job security, putting less upward pressure on wages. Now, if we look at job openings in the US, we can see that they have been steadily declining since its peak in March of 2022, suggesting that wage growth is likely to continue trending lower. And if wage growth does in fact continue to move lower here, then it would put downward pressure on inflation. There is one big caveat, however. If we replace the chart of wage growth with the Fed funds rate, we can see that the Fed began raising interest rates in March 2022. This marked the exact moment when the job market started to cool down, because when the Fed raises rates, businesses face higher borrowing costs, which slows down economic activity. In 2021, businesses could easily take out loans at near 0% interest rates to expand operations and hire new employees. But by 2022, those opportunities dried up as higher rates made borrowing far less accessible and much more expensive. The risk today is that if the Fed cuts interest rates too quickly now, then there's a chance that businesses could ramp up hiring again, leading to more job availability and higher wage demand, the exact opposite of what's needed for lower inflation. But the Fed probably understands these risks and have recently changed their outlook on interest rates. You see, back in September of 2024, the Fed was projecting 6 rate cuts for 2025. But in the last meeting, Powell said that the Fed now expects only 1 rate cut in 2025. That's a big shift by the Federal Reserve that's likely caused by growing inflation concerns. So even if the Fed kept rates stable at elevated levels, it could help keep a lid on job openings, just like it did from May to August of 2008, when the Fed kept rates stable, but job openings continued to decline. Such a scenario is possible today, which should continue putting downward pressure on wage growth and cause inflation to decline. And this downward pressure on inflation can be seen through something called supercore inflation, which focuses on price changes in services excluding the more volatile components like energy, food, and shelter. This metric is particularly useful because it highlights the most stable and labor-driven components of the economy, often a clearer view of underlying price pressures. By narrowing its scope, supercore inflation helps the Federal Reserve assess wage growth and demand-driven inflation more effectively when shaping monetary policy. see. This is what the chart of supercore inflation looks like. In early 2024, supercore inflation indicated a sharp pickup in inflationary pressures. For instance, the March 2024 reading showed a 5% increase, which is a very high number compared to the past decade. This showed sticky inflation, suggesting that inflation was particularly stubborn at that point. Since then, supercore inflation has cooled down, dropping to around 2%. So for now, not really telling us that we are seeing a sustained inflation wave. But the outlook still remains uncertain. Yes, inflation has been cooling for the past couple of years. However, there's no guarantee that this trend will continue. And one of the big reasons for that could be Donald Trump's tariffs. Tariffs can drive higher inflation by raising the cost of imported goods. When that happens, businesses typically pass at least part of the increased cost onto consumers through price hikes. So, in other words, causing inflation. There is some debate about the connection between tariffs and inflation. Some economists argue tariffs only cause one-time price increases, but not sustained inflation over time. And inflation remained stable during the flurry of tariffs during Trump's first term. Trump just doubled tariffs on Chinese imports to 20%, and he's also been promising and repeatedly delaying 25% tariffs on Mexican and Canadian imports, which could come fully into effect in the near future. And this uncertainty is already showing up in inflation expectations. A key metric called the one-year inflation expectations tracks what everyday people think prices will do over the next year. And the latest data point saw a jump from 3.3% to 4.3%, one of the largest spikes in the past decade, telling us that inflation is becoming a major concern again. So even though there are signs of cooling inflation, like falling wage growth and declining supercore inflation, people are still worried about the nearer-term inflation outlook, largely because of uncertainty around tariffs. If these inflation expectations keep rising and inflation does actually turn higher, then the Fed may have no choice but to step in and respond aggressively. For now, though, that's not the case. And it's possible that this is just another short-lived spike, just like we saw in April of 2023 and October of 2023, where inflation expectations surged only to reverse back down. Only time will tell. At Capital.com, we'll continue to provide you updates on such market developments. Thank you for watching.